No, I've done it. It's fine. I'll do it myself. Hi, good evening, everyone. Hi, good evening, candidates over Zoom as well as on YouTube. Can you please confirm if the audio video seems all right here? Hi, Mohit, Priya, Harry, Prakash, Tanish. Hi, good evening to all of you. By the way, those of you who are on Zoom, I'm also doing this session live on YouTube. So I'll suggest if you guys can move yourself to YouTube, I'll have to monitor only one chat box. That will make my life a little easy. All right, thank you very much for confirming. Hi, Sarah. How are you doing? Am I doing a crash course for level 2 this year? I will be doing a crash course for 2023 exams. 2022, I've already recorded one. So that should do the job. All right. Okay. So what are we doing today? We're starting with a new subject, corporate issuers. I don't know if you got a chance to check, but there have been some major changes between 2022 and 2023. Are you aware of that? Okay, there have been some. Harish, doing pretty good. Thank you very much. There are some significant changes in the curriculum for 2022, 2023. However, there is one reading which is common. And that's the reading that we would be learning today, which is relevant for both 22 as well as 23. The name of the reading is Dividend and Share Repurchases. Just give me a minute, I'll get this setup done. Okay. So if you're ready, I'm ready. We can start with the topic. Then maybe towards the end, we can have some general chit chat on discussion strategy and stuff like that. Should we start? Now, some of you've taken level 1 exams earlier. I think before 2020, you might have studied this reading in level 1 itself. Okay, so CFA Institute has been doing a lot of mergers and acquisition or placement. They've been moving readings from level 1 to level 2 within corporate finance and few readings. So some of you might have done certain sections of this earlier. It's a fun reading. It's an easy reading. The reading is on, the reading focuses on, as the name suggests, dividends and share repurchases. Do you know what share repurchases are? Buybacks, right? Share repurchases, simple, straightforward buybacks. Do you know that conceptually, if I ignore the legal part, like if I ignore the dividends, the taxation part, Do you know that a buyback and a dividend issuance is conceptually the same thing from company's perspective as well as shareholders' perspective? So when a company is paying dividend, at the end of the day, what are they doing, right? They are giving you some amount in cash, right? What is the impact on price of the share? In theory, the price of the share will reduce. When company is doing a buyback, a share repurchase, what is happening? They're giving you some cash, they're buying back some fraction of shares. The number of shares will reduce. So net effect, the wealth of the shareholder remains same. And that's the first point I want to start with today. Okay, so we're going to kind of try to build some comparison on what happens when dividend is paid versus what happens when repurchases are happening. For example, let us say we have a shareholder here, and let's say the gentleman is sitting on 5 shares of 100 each. So total wealth right now is 500. We'll look at scenario 1. In scenario 1, we will say that 20 rupees per share is given in the form of a dividend to the shareholder. So you get 20 rupees per share. Let's see what happens. How much cash do you think the shareholder will receive now? So 20 into 5 shares, right? So what's the total cash? 100. But then shareholder will also be left with a few shares. How many shares? 5 or 4? 5, right? We have 5 shares. So shareholder will left with 5 shares. And what do you think will be the price of the share in theory? 80. You're saying after paying dividend, the share price will fall. Really? You're saying after paying dividend, the share price falls? Is that what happens? Yes or no? Yes. So which means dividend paying is a bad thing. Good thing. Correct. So in theory, when a company is paying dividend, they just so think of it this way. Think of share as a piece of pie, and company giving you dividend is nothing but cutting down a small piece out of it and giving it to you, right? So you're left with remainder of the pie. So in theory, we say that the day on which shares go ex-dividend means you lose the right to receive dividend. That time the price of the stock will fall by the amount of dividend. So which means the share price now becomes how much? 80. So 80 into 5, your shares are worth how much? 400. So you still have a total wealth of 500. It's just that earlier your wealth was concentrated in equities. Now your wealth is broken down. You have 100 worth of cash and you have 400 worth of equities, right? That's one way to look at this. Let's look at scenario 2. In scenario 2, company announces a buyback, that they will buy back or repurchase 1 share for every 5 shares that you're holding. Okay, so you've total 5 shares. They decide to do 1 share for every 5. That's a 20% buyback program, right? They're going to buy 20% of the shares. So if you're a shareholder, you decide to surrender one of these shares, then how much cash do you think would you receive? You decide that you would give 1 share in the buyback program. How much cash will you receive? The price of the share is 100. So you'll receive 100, right? So 100 into 1. So cash that you have is 100. Now, what is the value per share after the buyback program? You'd assume that, or you'd hope that it remains 100. And some of those calculations we want to learn today. And how many shares? 4. So what's the total amount of shares you have? 400. So what's the total wealth of the shareholder? 500. So if you'd see the decomposition, it turns out to be the same, right? There's a cash of 100. There are shares of 400. There's a cash of 100. There's a shares of 400. So conceptually, dividend and buyback should result into the same thing. However, in practice, a lot of technical differences appear. One of the important difference is taxation. Correct? So in India, earlier we used to have, I don't know if you guys know, but we used to have dividend distribution tax. That when companies paid some amount of dividend, they used to pay 18%, 12%. It changed gradually. They used to pay some amount of dividend distribution tax. It was tax-free in the hands of shareholder. They changed it. Now dividend is taxable as per your taxable bucket, right? Whatever taxable bracket that you're falling in. So now we have a classic dividend double taxation system in India, in a lot of places in the world, also in the US, which means that company has some profit, they pay some taxes, then they have net profit. Then net profit is given to the owners in the form of dividend. Then in the hands of that owners, that dividend is income again, personal income. Then they pay personal taxes on that, and then they're left with the net profit. So the same profit gets taxed twice. That's a double taxation regime. So the way this reading is broken down, there's a little bit of theory and different tax regimes at the beginning, and then towards the end we have a couple of very interesting calculations. So the first part is theory, and the second part is we have some interesting calculations. I'm going to start here. So we're gonna start with the calculations. There are two variations of the calculations. We're going to go through them. Then I'll take you to learning outcomes, and then we'll start answering those learning outcomes sequentially. Here's the first concept we're doing today. We want to determine the impact on EPS or impact of repurchase program or buyback program on EPS. That if you run a buyback program, what happens to your EPS? Does your EPS go up or does your EPS go down? What do you think? If you run a buyback program, if you use your cash and buy back some of the shares, do you think the EPS will go up or EPS will go down? It will go up. Why do you think it will go up? Number of shares will go down. But do you think there will be no impact on profits? Because what is your EPS formula? EPS is earning per share. How do you calculate EPS? Come on, profit divided by number of shares, right? So you're saying that if I run buyback program, number of shares will go down. So denominator will go down. And therefore the EPS will go up is what you're saying. But how about any impact on numerator? Do you think there will be some impact on profitability of the company? Yes. Why? Because of the debt taken to buy back the shares. So you're assuming that I've taken debt to buy back the shares. Okay, let's see this. This is interesting. Let me create a few pages for ourselves. So let's say current. I'll just type this part. It's that way. The current profit after tax of the company. Just give me a minute. Again, if everyone on Zoom, if you guys can migrate to YouTube, it will be easier for me to monitor the chats. So let's say current profitability of the company is 5 million. The number of common shares outstanding is 10,000. In fact, I'll make it 100,000. It will be easier to run the maths. Then market value of the shares is, let us say, 200. Planned repurchase program is $20 million. Repurchase will be funded by debt. Okay. This will be borrowed at the rate of 15%. Tax rate is 20%. What I want you to do is I want you to calculate what would be the revised earning per share after you've ran the repurchase program. So we have a profit after tax of 5 mils, common shares 100,000, market value of the share is $200 per share. Planned repurchases of 20 million. It's going to be funded by debt. Tax rate is 20%. Calculate revised EPS. Think through it. The way to think through is you take the formula of EPS, which is PAT divided by number of shares. Then you figure out what will be the impact on numerator, which is your profit after tax. What will be the impact on denominator? Then you're good to go. Start. Joginder is saying, if I quit level 2 3 years ago, can I start again? If you have the time and the motivation, definitely. Monica's got the numerator. She's saying 3.25 mils is the new numerator. How many shares will you be able to buy back with this? 100,000. No, you can't do that. You can't. let's run a smaller program. We're being too aggressive. 10 million. Planned repurchase 10 million. Then the question is, who owns the company? $10 million is also way too large, but that's fine. It's about half of the outstanding market cap. Do you want me to solve this? Trying. How much? 40. So it's come down. Earlier it was 50, now it's 40. Are you sure? Okay. 23, 24. Okay. Anupam has got 31.25. Come on, it's an easy reading. I'm doing this one, you do the next one. Okay, observe carefully. It's very simple. You first start with basic EPS formula. Do you remember what EPS is? Earning per share. How do you get earning per share? You take profit after taxes divided by the number of common shares. Right? So I'm just writing total profit divided by number of common shares. Your total profit is 5 million divided by number of common shares is 100,000. So your current EPS is how much? Your current EPS is 50. Now you want to calculate revised EPS. Now here's a cool little trick for you. When you're calculating revised EPS, you start with the formula of current EPS. Okay, so you take the current EPS as it is, which is 5 million divided by 100,000. And then you'll have to make one adjustment in the numerator, one adjustment in the denominator. It will always work like that. What will be the adjustment on denominator? Once I buy back the shares, once I repurchase the share, the number of shares will reduce. So I need to figure out by what quantity my number of shares will reduce. So that's going to be a negative item here, right? My number of shares will reduce by some quantity. By how much? So I am buying total shares worth 10 million. I'm buying total shares worth 10 million. And how many shares will I be able to buy? One share is costing me how much? $200. So $200. So how many shares will I be able to buy back? I'll be able to buy back 50,000 shares. So my denominator, there's a deduction of 50,000. In the numerator, there will also be a deduction because when I'm buying back the shares, I'm actually funding it by debt. Okay. Now, this deduction of debt, does it have to be only deduction when it's funded by debt? How about if it's funded by internal funds? Will there be impact then? The answer is still yes. Why is that? Because even if you have internal funds, you're not keeping them, under your bed, right? You're still parking your funds somewhere. And when you're parking your funds somewhere, those funds are generating you yield. That yield is currently a part of your total profit. The moment you use that to buy back, there is no yield for you to exploit, right? So from a calculation perspective, if it was not debt, if it was internal funds, then the only thing that would change is instead of funded by debt, you would say funded by internal funds, which were generating a yield of 15%. Calculation will still be exactly same. There will be no change whatsoever. Tax will still be relevant. Okay, now this is the tricky part here, that my profit will reduce by how much? Okay, so how much debt are you going to take? You're going to take debt worth $10 million. So you take debt worth $10 million. On $10 million, you pay interest at the rate of 15%. But hey, if you remember, if you pay interest, there is someone who gives you a discount, the tax department. Remember, what do we call it? Tax shield. Why is that? Because when I pay interest, my profit reduces. And if my profit reduces, then I take the benefit of that reduction in profit by paying less taxes. So here, even though my cost is 15%, but my true cost is actually 1 minus the tax rate of 20%. I'm going to get that 20% discount here. So this is going to turn out to be how much? This will turn out to be 1.2 million, correct? So 1.2 million is the true cost of interest that you have to pay. So you have to factor in the tax shield. I'm going to show you these calculations in depth. Okay, but for the timing, amount of debt into 50% into 1 minus the tax rate. So this gives you a revised EPS of how much? Revised EPS of 76 point. Come on, do it. 3.8 million divided by 50,000. 3.8 million divided by 50,000. 76 point. That's it, 76. So 76 is your revised EPS. Interestingly, your EPS went up in this example. Getting the hang of it? Now I want to explore this calculation with you a little bit more. Okay, in terms of what might have happened. Nikit is asking, will 10 million be not reduced from PAT? Because that is a principal I borrowed. No, Nikit. When you borrow, borrowing doesn't reduce your PAT. The interest that you pay reduces your PAT. So borrowing is a capital nature transaction. Payment of interest is an expense nature of revenue nature of transaction. Okay, so let's do a little bit more on this before I kind of conclude this. We should explore this a little bit more. So I'm going to create some sort of a before and after structure for you. Okay, so this is before repurchase. And then I'm also going to create an after repurchase so that you would get a visibility on what has really happened. So we'll create usual structure. We'll say sales less some operating cost. Okay. And then it will give us the EBIT directly. Then we will assume interest cost. It will give us EBT. We will assume taxes at what rate? 20%, and then it will give us EAT. So that's my structure here. Okay. So we have EBT here and we have EAT here. Now before repurchase, your profit after tax was how much? 5 million. So I'm just going to write this as 5. That's where we started, right? The question told us that profit is 5. Now, if my profit is 5, I'm going to do reverse working on what should be my earning before taxes. So I'm simply going to do 5 divided by 0.8, 1 minus the tax rate. So this has to be 6.25. Make sense? So if my earning before tax is 6.25, and then if I apply a 20% tax on that, then I pay a tax of 1.25, and that's how I get earning after tax of this value. Guys, are we together here? Now, what was my interest cost before repurchase? So we'll assume there was no debt. So if there was no debt, what must have been the interest? 0. So then what must have been my, it would have been 6.25, right? So my interest was 6.25. Now I will assume a operating cost of some random 4. I'm assuming this randomly, I'm not putting any logic to it. It doesn't matter. So if this is 4, then what must have been my sales? 10.25. Okay, this is assumed. There's no logic to that 4 at all. So now this was assumed that this was my income statement before repurchase. Okay, now see what happens after repurchase. If I do the repurchase, do you think it has any impact on my sales? No. So my sales is same. Will there be any impact on operating cost? No. So operating cost is same. Will there be any impact on EBIT? No. EBIT is also same. But do I have to pay any interest? Yes. How much? On 15 million, I have to pay, sorry, on 10 million, I have to pay interest at the rate of 15. So I have to pay interest of 1.5 to the bank. Isn't it? Interest I have to pay 1.5. But then my EBT will now reduce, and my EBT will now become 6.25 minus 1.5. That will be 4.75. Agree? I'm paying interest of 1.5. This is 4.75. On 4.75, I should pay taxes at what rate? 20%. So 4.75 into 0.2, I'm paying taxes of 0.95. So what would be my net profit? Net profit would be 4.75 minus 0.95. This is 3.8. Now, instead of doing all this, if you notice what we did previous example, we said 5 million minus the after tax cost of interest, which was 10 million into 15% into 1 minus 20%. This was my numerator, right? Look at this. What was my numerator? Numerator was 5 million into 10 million into 15% into 80%. So when I do this, it directly gives me 3.8. So do the math here. 15 is 1.5 into 80 is 1.2. So that's 5 minus 1.2. That should get you 3.8 directly. So that's how we're getting the new numerator directly. Okay, easy, manageable. All right, now let's do the next example. So now next example, I want you to do two scenarios. Okay. This is going to be scenario 1. And this is going to be scenario 2. We give them some sort of a color code. It's too harsh. Now in the second scenario, the only thing that I'm going to change is the cost of debt. So in scenario 1, we have similar calculation, but your cost of, I've changed the market value and made it as 500. Okay. Cost of debt is 15%, tax rate is still 20%. In scenario 2, market value is still 500, but I've made the cost of debt as 7.5. Okay. See if you can do this. This should be fun. I'll be sharing this PDF, by the way. You don't have to worry about writing, just focus on learning. Share repurchase price, Anupam, is the market price. So in both the cases, market price of the share is 500, which is I think a logical thing to look at. Done. I've started getting answers. A lot of candidates, Ankit, Monica, Prithvik, Mohit, Silky have 47.5 and 55. That's a good observation, Vicky. That's what we're going to explore. Yeah, but you're right. We're going the same direction. Vicky is saying percentage change in NI is lower than percentage change in share. Yeah, so we'll explore that. $47.5 and 55. That's what Majid thinks. Silky has also got 55 in scenario 2. Let's do it together. So you first start with, your current EPS calculation. Your current EPS is simple, 5 mils. 5 mils divided by 100,000. How much is that? 50. Same current EPS, 5 mils. 5 mils divided by 100,000. That's 50 again. Now you start doing revised EPS calculation. So I'm just saying our EPS here. So you start with 5 mils in the numerator. Start with 100,000 in the denominator. One deduction in the numerator, one deduction in the denominator. Denominator will reduce by how many shares you have been able to buy back. Remember, the market value of your shares is $500. You're doing a buyback of how much? $10 million. So one share you're buying for $500, you're buying total shares worth 10 million, right? So how many shares will you be able to buy back? So 10 million divided by 500 shares. So number of shares you're able to buy back is 20,000. So you're buying back 20,000 shares. Now, how are you funding the buyback? You're taking a debt, which is in most of the cases a very stupid strategy in practice. Right? Very rarely you'd see companies saying we are building leverage, and maybe private companies can do that, but public companies in most of the cases, not a very positive signal. But doesn't have to change your calculation even if these were internal funds, right? Calculation would have been same. So funded by debt at 15%. So how do you calculate the impact on the numerator? So you'll say, okay, I'm getting new debt of 10 million. I'm getting this debt at 15%, but hey, I'm getting a tax discount or tax shield benefit. So multiplied with 1 minus 20%. So that will be how much? Same 1.2 million. Is it correct? So 10 million into 15% into 80%, 1.2 million. So your calculation will turn out to be 3.8 million divided by 80,000. 3.8 million divided by 80,000. Help me out with this. How much? How much? 47.5. There you go. That's your first one. Second one, revised EPS. I start on the same footing, 5 million divided by 100,000. Number of shares you're going to buy back is going to be same, 10 million at 500. So number of shares you're buying back is how much? 20,000. Correct? Same calculation. What will be the impact on numerator? So this time around, your cost is different. So it will be 10 million into 7.5% into 1.2%. So that will be 600,000. How much? 600,000. So you have 600,000 here. And that should get you a revised EPS of how much? 55. 55? Okay, good. Okay, calculations are fine. Now something very cool to observe here. Notice in one case, your EPS is going from 50 to 47.5. So when I started the session, I asked you this question. Will EPS increase or decrease? In one case is going from 50 to 47.5. In one case is going from 50 to 55. Right? So EPS will increase or decrease. The answer is depends. Depends on what? Depends on cost of borrowing. So in one case, your cost of borrowing seems to have gone up a little bit, right? But then when you say high or low, compared to what? Correct. So compared to high or low is in comparison to something called as an earning yield. Have you heard of earning yield before? Have you heard of price earning ratio? Price earning ratio, what's the formula? Price divided by EPS. Price earning, price divided by EPS. So usko ulta kar do. So if you invert the price earning ratio, what happens then? EPS in the numerator, price in the denominator, that's your earning yield. So whether your EPS after buyback will increase or not, a back of the envelope calculation that will work for you is to compare these two numbers. Okay, look at which two numbers. You want to compare your earning yield, which is nothing but EPS divided by market price. Inverse of price earning ratio. This you want to compare with after tax cost of borrowing. After tax cost of borrowing. Okay. And let's say that your earning yield, let's look at scenario 1. and scenario 2. Now, what was your EPS before? Your EPS was 50. Correct? EPS before in both the cases was 50. What was the market price? Come on, help me out. What was the market price? 500. So 50 by 500, how much is that? 10%. 50 by 500, how much is that? 10%. So your earning yield was 10%. What was your cost of borrowing? In scenario 1, it was 15%, but you calibrate 15% with a 80% or 20% discount because there's a 20% tax break here. So this is how much? 12%. In scenario 2, it was 7.5. Correct? So you compare 7.5, but you again adjust that for after tax cost. 1 minus 20, how much is that? 6%. So in one case, when your after tax cost of borrowing is higher, is it higher? Your cost of borrowing is higher. This is where your EPS will fall down. So look at this. EPS went from 50 to 47.5. In the second case, when your after tax cost of borrowing is lower compared to earning yield, this is where your EPS will go up. So if you notice here, from 50, EPS went to 55. So that's how you conclude. You compare the earning yield versus the after tax cost of borrowing. Okay. And why do you compare that? Because earning yield is essentially contributing the impact on the denominator in terms of how many shares are deducting in a proportionate way from denominator, because it's giving you current EPS and current market price. It's giving you some sort of a ratio there. And cost of borrowing is basically showing you what percentage of deduction you have in the numerator. Okay. Now here's a cool example for you. We'll take the same data, but this time around, I'm going to change my cost of debt to 12.5%. I want you to do the math quickly. Change your cost of debt to 12.5% and tell me what you get. Come on, do it quickly. How much? 50. So here, if I do before, calculations, the original EPS, it will be 5 mils divided by 100,000 shares. So that's 50. If I do revised EPS, it will be 5 mils divided by 100,000. There will be a deduction from the numerator and denominator both. So how much from denominator? The same 20,000 shares, right? That doesn't change. So you're still buying back the same 20,000 shares. What happens in the numerator? Numerator, you're doing 10 mils into 12.5% into 1 minus 20%. So that will be 5 mils minus 1 mil, correct? And this will be 80,000 and you end up having the same 50-50. Why was that? Because what is the earning yield here? Earning yield is same. 50 EPS divided by 500 market value, 10%. What's the after-tax cost of borrowing? After-tax cost of borrowing. So it is 12.5 into 1 minus 20%, which is also 10%. There is no impact on EPS. Zara, easy? Should we move forward? Okay. So this is one of the 2 calculations we have to do in this reading, like 2 major calculations. There's one more. The next set of calculation is figuring out impact on book value per share. Okay, I hope all of you are with me. We can go on, right? Okay. So now, what will be the impact on BVPS? Neha is asking, do we need to consider tax rate if funded by internal funds? What do you say? If you're not taking debt, you're funding it with your internal funds. Should we be worried about tax rates? Yes. Why? Because whatever you earn, that's also taxable, right? For example, I have some my own cash. I'm planning to use it for buyback. Now, right now, my money is deployed in debt funds. Do I need to pay tax on interest that I'm earning? Yes. That's my earning, right? So I still have to pay taxes. So which means whether you do it from debt or you do it from internal accruals, your calculations are going to be exactly the same. You still have to consider taxes in both the cases. Ankit, hopefully that answers your query. Vicky, no, your calculations will be same, but instead of giving you cost of debt, you would be given yield on internal funds. So the same question, I can just say, instead of saying funded by debt, I can say funded internally and yield on internal funds 12.5%, and your calculation is going to be still the same. All right, impact on BVPS. Let's say the current net worth of a company is 500 mils. Common number of shares outstanding 10 mils. Market cap of the company $700 mils. Planned share repurchase program is of 100 mils. Okay. You need to determine what would be the impact on. In fact, let me throw in some interesting. It would be funded by internal accruals. The yield on those funds was 11%. Tax rate will be 33.33%. Determine the revised BVPS. Yeah. Are we reaching somewhere? Yeah. What's happening? Okay, let's do it together. You might have some doubts, so I want you to like observe carefully how I'm doing this. So you calculate first current BVPS. How would you do current BVPS? You take the total book value of or total net worth of 500 mils and you divide that with number of shares. That's 10 mils. So your current BVPS is $50 per share. That's easy, right? Then you do the revised BVPS. Now, revised BVPS, you start with the current formula first. So revised BVPS, start with the same formula. 500 divided by 10. There will be one adjustment in the numerator, one adjustment in the denominator as usual. What would be the adjustment in the denominator? The number of shares bought back. Number of shares bought back. Number of shares bought back. All right. How would you figure out how many number of shares have been bought back? You're going to buy back shares worth 100 mils. And what is the value per share? So let's calculate market value per share. So market value per share is nothing but market cap divided by number of shares, right? So market cap is 700 mils. Number of shares are 10 mils. So market value per share is how much? 70. So एक share $70 का है. One share is $70. Now you're going to buy back total shares worth 100 mils. So how many shares will you be able to buy back? So you would say 100 divided by 100 mils divided by $70. That will be how much? 1.43. Give me a few more. That's it. 9. How many shares? 100 mils divided by $70 is 1.4285 million shares. So number of shares you can buy back is 1.4285 million shares. And what happens to your book value? Think on a balance sheet structure. You have certain assets, you have certain liabilities. This is your net worth. Now, when you're buying back, are your assets increasing? When you're buying back shares, do your assets increase? No. Your own shares are not your assets, by the way. When you buy back shares, your assets don't increase. But you've taken the debt. So will your liabilities increase? Yes. So what do you think happens to the net worth? Net worth will go down because your assets are same, but your debt has gone up, right? And that's the accounting entry we pause. We anyways reduce that amount from equity and equity share capital and all those sections. So which means whatever is the amount of buyback, by that amount, my BVPS is going to reduce or my total net worth is going to reduce. This was not required. That 11% and 33.33% was useless. That was more of a trap, a common thing on level 2 exams. And that gives you how much? 46.6. So 46.6. That's your revised book value per share. Ask me questions. there's anything that you'd like to ask. What to do with this? Why did I give you? I say just having fun. What is the reason of not taking? Taxes will be applicable on profits or losses. These are balance sheet entries. Like, think from accounting perspective. What are we doing? See, let me show you how accounting happens for repurchase. Okay. So typically there is something called as an equity share capital. Then you have ton of different reserves, right? Retained earnings and whatnot. Let's say equity share capital is 100. Reserves are, I'll stick to the same example. Reserves are, let's say 400. Okay. And then you have some other liabilities of, let's say 1000, and you have assets of 1500. The total of these two is your net worth, which is 1500 minus 1000. Are you following this? The balance sheet is tallying on 1500, 1500. When you decide that I'm going to run a buyback program, what you're doing is you're borrowing 100 million of liabilities and you're repaying 100, you're reducing 100 million worth of equities. So in the US, we call it as treasury stock. So it's a negative item in your equity share capital. Negative means, and in India, we just deduct it like that. So we'll reduce 100 from equity. So what is the new balance sheet going to look like? So new balance sheet will be assets are still 1500, but what's your liability? 1100. And what's your total net worth? It will be 100 plus 400 minus 100. How much? 400. So your net worth reduces by 400, which is your numerator here. It's got nothing to do with the 11% yield or tax rate of 33% at this moment. Now, if it is funded by internal accruals, for example, okay, like I think in this example, I did not give you debt. I gave you internal accruals, right? Then how does the balance sheet look like? Same stuff. If you're going to fund it with internal accruals, this is your original balance sheet. Okay, so you have equity share capital of 100. You have reserves of 400. I'm just copy pasting it. You have liabilities of 1000. And you have assets of 1500. You decided that, okay, fine, I'm going to run a buyback program. Okay, right now your balance sheet is tallying at 1500, 1500. I'm going to run a buyback program with my own cash. So you pay 100 million worth of your own cash, your cash reduces. Agree? Second effect, your equity reduces. So now your total assets are 1400. Your liabilities are 1000. What's your revised net worth? 400. Either ways, you take debt or you fund it with internal accruals, the net impact would be your net worth will reduce by 100 mils. Is it okay? All right. There will be no impact of. Okay, so question that's being asked is there an impact of 11%? That's next year on my P&L. Yield I don't earn today. Yield I was supposed to earn throughout the year. So it will have an impact on my EPS. Next year, it will have some impact on my EPS, some impact on my total profitability. But as of now, today, it will have no impact on my book value per share. Sorry, did I say book value per share? No, it will have no impact on my total book value. It will have impact on my book value per share. In this example, your book value per share reduced. Earlier, your book value was 50. Now your book value per share has come down to 46.6. No, confused. Okay, let's do two examples. Let me show you. Okay, for a minute, let's just ignore this. I think confusing you people was not a good idea. Correct, because it doesn't matter because I'm working on balance sheet right now. I'm not working on P&L. So let me show you two examples. You'll understand what's happening. Give me a minute. Let's get rid of this. So again, we have two scenarios. What I'm going to do here is, this scenario will do the same calculation, so we'll save time. In this scenario, let me change the market cap to 400 mils. Everything else is same, but market cap to 400 mils. Okay. What I want you to do is, in scenario 1 and scenario 2, I want you to calculate original BVPS and I want you to calculate revised BVPS. Original BVPS and revised BVPS. See if you can do this. Start. Keep your questions on hold. I think after this, it will make much more sense to you. How much? 53 point. Okay. So the current BVPS is same, 500 by 1050. Current BVPS is 50. Revised BVPS, you take the whole net worth of 500 mils and you have number of shares as 10 mils. You say, okay, in 500, I'm going to run a buyback program of 100 mils. So my equity will reduce by 100 and I will be able to buy back, how many shares were those? 1.4285. So this gave me 46.6. Here revised BVPS, 500 minus 100, 10 minus, how many shares will I be able to buy back? So I'm running a buyback program worth 100. And what is the market value per share now? 40. So I'll be able to buy back 2.5 mils. So I'll be able to buy back 2.5 mils. So 400 divided by 7.5, how much? 50? 3.3. Look at this, compare these numbers. Again, this is very interesting. We have original BVPS 50, it became 46. Original BVPS 50, it became 53. In one case, it's increasing, in one case, it's decreasing. Why? Correct. Again, proportionate calculation, numerator, denominator, nothing to it, right? So what's happening here is, you want to compare BVPS versus MVPS. So in scenario 1, BVPS and scenario 2, in BVPS in both the cases was 50. But in scenario 1, what was the market value? 70. So a 50 in your books, you're buying it at 70. And 50 in your books, you're buying it at 40. So in this scenario, your revised BVPS will go down. In this scenario, your revised BVPS goes up. Easy? Good. So these are the two calculation oriented learning outcomes. Then we have some smaller theory nuanced items. Any questions I can take on them, you can throw them on the chat box now. Hopefully you've understood these two. If you have any questions, you can please throw them on the chat box. It's a 20-second lag with YouTube. Got to be a little patient. Yeah, iPass would be nice as well. First question, Rayan is asking, is the IRR or interest rate reflected next year, right? Yes. And it would be reflected on your P&L, but yes, next year, you're correct. If debt funded, will it be same? Yes. Michael, you funded with debt or internal accruals, your calculations are same. Can finance companies and NBFCs do buyback? Good question. I think they can, but I'm not sure. I don't track those companies, but I don't know any rule which prohibits them from doing buyback as long as they're maintaining the regulatory capital. Okay, fantastic. So here's what we're going to do. I'm going to end the stream on YouTube now. We're going to take a 10-minute break. I'm going to put on the timer. All of you requested to come back to Zoom. And after the break, then we'll continue and wrap up with rest of the theory sections. Right, so I'm putting on the timer and ending the stream here. You were also broadcasted. Oh, I didn't know that. Okay.